In traditional banking, account fees and interest rates are fundamental mechanics. Banks often charge fees for account maintenance, transactions, or overdrafts, which are sources of revenue for them. On the interest side, they pay interest on deposits to account holders, which tends to be lower than the interest they charge on loans. This difference in interest rates, known as a spread, and its primary way for banks to earn profit. A key aspect of traditional banking is the conversion of deposits into loans. When individuals and businesses deposit money into a bank, these funds don't remain idle. It becomes part of a larger collective pool of funds, consisting of the deposit from thousands, if not millions of other customers. This pooling is fundamental to how banks manage and utilize funds. When a bank grants a loan, be it for a mortgage, a car, or a business, the money lent out comes from the pooled fund. This system allows the bank to transfer short-term deposit into a long-term loan, a process known as maturity transformation. By pooling funds, banks can achieve liquidity management. They count on the fact that not all depositors will withdraw their money at the same time, allowing the banks to maintain a smaller reserve compared to the total deposits. This pooled fund system also enables banks to offer interest to depositors, as the loans made from these deposits generate higher interest income for the bank. This pooling of funds leads us directly to another critical aspect of banking operations, which is the money market and interbank lending. While the pooling system is efficient in managing funds for long-term loans and earning interest, it also presents a challenge for banks, which is liquidity management. Banks need to ensure they have enough liquid assets to meet daily operational requirements and unexpected withdrawal, which demands by depositors. This is where the money market becomes instrumental. The money market is an essential component of the financial system, where short-term funds are borrowed and lent. It includes trading in highly liquid financial instruments, such as treasury bills and commercial paper, often with maturity of less than a year. Banks participate in the money market not only as a means to invest in short-term surplus funds, but also to borrow when they face a shortfall in liquidity. This ability to quickly adjust cash position is vital for maintaining the day-to-day operations of banks. A significant activity within the money market is interbank lending. Banks lend to each other to manage their liquidity needs, typically on overnight basis. This interbank market is a critical tool for banks to meet their reserve requirements, which is the minimum cash reserve that regulatory requires banks to hold against customer deposits. Interbank lending rates, such as London Interbank Offered Rate, are key indicators of the health and liquidity of the banking system. They influence a wide range of interest rates, including those for customer loans and saving accounts. By enabling banks to borrow from and lend to each other, interbank lending serves as a buffer, providing flexibility in liquidity management. It helps ensure that even if a bank faces a sudden spike in withdrawal demands, it can borrow funds quickly from each other, thereby maintaining its operations and depositors' confidence. This leads us to the concept of fractional reserve banking. Fractional reserve banking is a cornerstone of the modern banking system. It's a system where banks hold only a fraction of their depositors' money in reserves and use the rest for lending or investing purposes. Let's break down how this works and its implications. In fractional reserve banking, when you deposit money in a bank, the bank doesn't keep all the money on hand. Instead, it is required to hold only a fraction, say 10% of the deposits in reserve. The remaining 90% can be lent out to other customers. This system allows banks to create credit and thus contribute significantly to the economic growth by providing necessary funds for customers and businesses. This practice effectively multiplies the money supply within the economy. When a bank lends out money, these funds eventually get deposited back into the banking system, allowing for further lending. This multiplication of the money supply is a key aspect of how banks contribute to the economic activity. However, fractional reserve banking carries inherent risk. If many depositors suddenly decide to withdraw their funds, a scenario known as a bank run, banks may not have enough liquid assets to meet these demands, leading to potential insolvency. This risk necessitates stringent regulatory oversight and mechanisms like deposit insurance to protect depositors. Critics of fractional reserve banking point out that it can lead to an excessive money creation. Furthermore, it places a considerable trust in bank and the decisions making and risk management practices. In light of these critics, alternative models like those proposed by DeFi, which offer transparency and risk distribution, are increasingly gaining attraction. Before we conclude our discussion on traditional banking mechanics, it's crucial to understand the pivotal role central banks play in this system. Central banks like the Federal Reserve in the United States or the European Central Bank in the Eurozone serves as regulators for the commercial banks. They set an important guidelines and requirements that commercial banks must follow, ensuring stability and soundness in the banking sector. Central banks are responsible for setting and implementing the country's monetary policy. A key aspect of this is managing interest rates. By adjusting the benchmark interest rate, central banks influence borrowing costs, consumer spending, and the overall economic activity. In times of financial distress, central banks act as lenders for last resort to commercial banks. This function is crucial in preventing bank runs and ensuring liquidity within the banking system. Central banks control the money supply in the economy through various tools, including open market operations, reserve requirements, and setting discount rates. Their actions directly impact inflation, unemployment, and economic growth. Central banks also influence interbank lending. By setting the rates at which they lend to the commercial banks, they indirectly influence the rates at which the banks lend to each other and the consumers.